You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, you read it on the screen. It's why you're listening. We've got Brendon Ptolomey back in the studio for our quarterly market update. Brendo, cheers for coming in, mate.
Hey, Trent. Thanks for having me, mate.
Hey, a lot's happened in the last quarter. We've had the 5% first home buyer guarantee scheme being brought forward from what was going to be the 1st of Jan.
Yep.
We've had Minister for Housing and Planning, John Carey, come out in the last couple of weeks talking about his new scheme of increasing density around a bunch of train stations in Perth that currently don't really have it.
Yep.
Let's talk about that. Interest rates seem to be sitting where they are for the foreseeable future. How will that affect our market? As well as just a little bit of a update on how spring selling season is going from a stock on market and demand perspective. Mate, how are you going? How's the business?
Yeah, mate. As you can expect, with the amount of activity out there in the marketplace at the moment, we're super busy, and in particular to pick up on the 5% deposit scheme from the federal government. That drives a lot of valuation business because you're talking about people with low LVRs, and that's usually, almost always, will generate a valuation in the background when that finance is being approved. So, yeah, couldn't be happier in terms of the way that's going. Sometimes in a market like this, surprisingly, valuation volume can go down because there's so much pre-approval in place and it's been spread over a year, and each transaction doesn't necessarily trigger a valuation, but at the lower end of the market, it certainly does. Yeah,
good. It's good to hear that the valuations industry is benefiting from the increased activity. And let's probably start with that activity. Let's go backwards, I think, on the list I just gave. We'll start with an update on where we're at. We consistently see 900 properties a week being bought right now, Brendo, and what that represents is just under a third of the stock on market right now.
Yep.
We just ticked over 3,000 properties from a couple of months stint for the first time ever in the 2000s. What the hell is going on there?
Yeah.
And you juxtapose that against what was run up to 5,500 properties on the market this year, where we're just over half the amount of properties of what was on the market last year, which is just over a third of what a balanced market would have been. So what we're sitting at is easily a quarter of properties that we really want to have on the market right now.
Yeah.
And the outlook, obviously, is one we'll talk about now.
So let's just double check. Same week last year, there was about 5,500 total properties on the market. Of those right now, we've got just over 3,000, as you've said. Of those, 2,000 are houses, so single residential dwellings on the market, and a couple of really interesting things going on here. So units, says there's, according to REWA, 650 odd units on the market, but people are coming for those real hard right now. So in particular, established older apartment complexes, that people are seeing value in those, and so that activity is picking up, and with activity comes value increase. Single residential market is going absolutely crazy, and we'll talk about some of those examples in a second. But the other thing that will float through in news over the next month or so is developers sold out of the land stock that they had during September and October. And we are sitting here now in November with some of Perth's biggest builders saying to us, we've got customers and we've lined them up to sell them a house. Now we don't have a block of land to sell them or find them in the marketplace because we sold out. So the shelves are bare on vacant land as well.
Isn't it an interesting dynamic where the sales rep for a building company turns into a buyer's agent for their clients?
To find the block of land, yeah, correct.
That's what we're noticing at the moment. As the listenership probably would remember, strategic, we've got a number of land developments in play at the moment. And so our relationship with the market is sales reps calling us, begging us for stock, asking us, hey, have you got somewhere I can place my client? And it's really weird. It's like we're the sales agent and they're the buyer's agent.
Yeah.
And when we do a new release, prices are pretty mental, to be frank. If you think about Henley Brook, for example, when it first released about 6 years ago, a 328 square metre block was selling for about 260 grand. Cedar Woods just put a few blocks on the market in their recent release for $430,000 6
That's
years
crazy.
later.
For a similar size block of land.
Same size block. Actually a little bit less than 13.
Wow.
And so when you think about price growth on any property, that would be one of the market leaders.
Yep. Yeah, absolutely. And just to string that out a little bit and bring it back to established dwellings. So that price point that you're alluding to there, so if we take that block of land at $400,000, construction cost on a new house on that block of a decent size will be $350,000 to $400,000. Voila, technical term, we end up at $800,000, and that's where the pressure is in the marketplace at the moment. That's what our valuers are seeing at the lower end of the value scale. In suburbs that probably traditionally were seen as affordable and now are moving to that $800,000 mark because of the first home buyer scheme sucking the value up to that new level. So those examples for listeners, and these are into those valuer stories that we get back in the office daily, weekly at the moment. So we're talking about Westminster properties here, infill development, 3x2s on a 250 odd square metre block of land, triplex type unit.
Yep.
Nice product. And in January, those dwellings were transacting around $600 to $650. In fact, we've got an example at $620,000 in the same complex, not the same unit, but in the same complex, just transacted in September. $800,000 was the offers. There was 30 offers on that property. So I'm just trying to give people a flavour of the activity around that price point. Now, to be brutally honest, our valuer was having really a lot of trouble to say that, you know, finance valuation, that $800,000 was an acceptable value.
What do you do then?
We valued it at less than that, obviously confidentially can't say. But what we do is we come back to the definition of market value in this marketplace. And that definition, without boring listeners too much, talks to there being a willing buyer and a willing seller, where they're acting diligently, prudently, and without compulsion is the words in the definition. And what we're saying there is we don't think that the person that's offering at $800,000 has all the knowledge that they need to have in that marketplace, and they are acting with compulsion, as in they're getting a little bit too excited with their numbers and offering above what we think the place would resell for in the market.
But you said there were a lot of underbidders.
Yes. Yeah.
Normally, when you speak to me about that, you would support the number because of the underbidders, that there would be another bid at that price if they had to, if this guy fell away with finance.
Yeah, and again...
So why aren't you supporting 800 in this situation?
In this situation, we had sales evidence of, in the same weekend, saying that lower than 800, and I can't obviously say the numbers, but lower than 800 was more appropriate in the market at that very point in time. Now, everyone needs to understand this weekend that might be worth $800,000. So this is where our job gets really difficult. Yeah. We're 1.5 months down the track from that valuation, and in all honesty, it might be 800 now. It's a pretty stressful situation for our valuers to be in, but everyone probably needs to show some sympathy in terms of what those definitions are and also the timing of when we're doing the valuation, because it's that point in time, the day that we do the inspection, that the valuation's been judged upon.
That unit would have transacted for about $360,000 in 2019.
Yeah, which again brings another price point into this. We were very used to that type of value level, and that's why I describe that suburb as being an affordable suburb when we start this conversation. And that's where we get really concerned about where value's going in this city in terms of people getting in at that type of price point. Current median house price, according to RE, was $820,000. That can only go up from there when the lower end of the range is now already at that number.
If you think about replacement cost, I can bet you my bottom dollar it would cost more than $360,000 just to build that triplex unit these days. Whereas back then, that house would have been built for $190 maybe. So again, that reflects about a 90% increase in build cost in that time, and we know that's a statistic in the first place. But it also does talk to how the increase in the population requiring somewhere to live, being the land side of things, but also the increase in inflation in the cost of construction. Add those two things, the house and the land bit, you don't have to be in a house and land suburb to see the increase in values. Actually, you can go to an infill suburb like Westminster and see that same outcome.
Yeah, absolutely. And then that leads back to where we were talking about units. So people are looking at the cost proposition there in terms of getting it at $800,000 and starting to wonder what other types of product they can buy. So to get to Westminster in an infill group house like that, they may have already been out in further suburbs further out of Perth, looking at that $800,000 to block and build proposition. Now the market's saying, what can I buy for $800,000, say, as a unit in the circumference around Perth Metro, in, say, a Subiaco, a Mount Hawthorn, Mount Lawley, over to Vic Park, down into South Perth, and even down towards Coburn and maybe even out to Joondalup. How much do I get for $800,000 in a unit market, and then am I happy with the lifestyle that comes with that property purchase? So
are we talking about second-hand apartments, 201s, things like that in East Perth, West Perth, Subiaco, as you just said?
Yep.
you can probably be at that point at the moment.
Yeah, absolutely. So you're looking for probably best case scenario 2x2 at that price point would be a real win. And then you want to remember that you're coming back to lifestyle opportunities. So you want that complex that is walking distance to a train station, walking distance to your favourite cafe or park or gym or whatever that lifestyle part that you're looking for. And then you're also looking longer term. Let's look at the repayments on this, hopefully are not too dissimilar to the rent I would pay for a similar type of product within the suburbs. And so what I'm trying to do is avoid paying someone else's mortgage, and I'm getting a mortgage on my own apartment to pay off my own mortgage and create some equity into the future.
That's exactly what I've seen one of my friends do very recently in the last few days. They've gone and purchased one of the older flats on a walk-up flat 2x1 in Yokine for about $530,000. Now, that would have been worth mid to low 200s pre-COVID. It hasn't increased in amenity or improvements in any way. In fact, it's probably depreciated in the last 6 years. And again, reflection of this where the market is at for everything else, sucking that up. But again, it's her getting into the market so that if there is any equity upside, she's going to benefit from it and not continue to fall behind on this debasement of currency really that's going on in the property market right now. But I guess it leads me to a thought process I'm having right now. On the 2nd of December 2018, which is nearly 7 years ago now, we recorded the first episode of this podcast, and the theme of that episode was green shoots.
Yes.
And we were talking about green shoots in the market in general.
Yep.
Are we at a point now where you're talking about price points for triplexes that are now starting to get to a point where maybe this is the genesis of green shoots for broader apartment development pricing starting to be acceptable to the market? Or is it too early to call that? Are we still another year of growth away from that working?
Yeah, great question, Trent. And the answer is the green shoots are just coming out of the ground. And so the indication...
seeds are in the ground.
Yeah, seeds have been there for a while.
Yeah.
And
dormant.
Apartment developers have been trying to fertilise them. So what we're seeing is... most developers will tell you that they need somewhere around about $13,000 to $14,000 per square metre on apartments to get new product out of the ground. There's lots of factors going on there, and hopefully you've understood how we've talked about this in the past for listeners, that this is all about a feasibility game for the developer. No one does anything for free. You need to make a profit when you do these things.
Or a loss. No one does anything for a loss,
Absolutely.
Right? Which has been the reality since COVID.
Yeah, if they had bought something out of the ground, potentially making a loss, in particular around affordable product. And so what we're seeing now is existing stock come up to a level where providing new stock into that market at that value level, as in competing against this established stock, is becoming viable. And so the feedback we're getting from residential medium to high volume apartment developments is that they have a limited number of builders available in the marketplace. If they've got their approvals in place and they've got their feasibility sorted out, they are now in negotiations with a builder to come up with a contract price that determines whether they will or won't make enough return to get that development out of the ground. And there's pressure. So builder is probably sitting there going, I'm not going to do this unless I make enough margin on it, which is all quite normal and quite acceptable. And then the developer's saying exactly the same thing. Where they have to come to an agreement is what that figure is in terms of what the construction is and whether there's a margin between the cost of doing the project and what they can sell it for. And I'm told that in those negotiations at the moment, the biggest pressure is, number one, lack of supply of competition to get the price right for builders. And then number two, if you miss that builder, i.e. you don't sign them up in this period of time, their next availability could be a year down the track.
Or the next apartment project finishing, right?
Yeah, exactly.
And the risk to a builder is, we saw some stats come out very recently from a construction market report saying that they expect construction costs in Perth over the next 3 years, which is the time frame of, hey, let's talk about building an apartment building to finishing it, but to be 20%.
Yeah.
And that might be their margin in the first place. So you'd have to think about them putting 20% on for the risk in the next 3 years of building it.
Yeah.
Plus maybe that 20% for building it.
Yep.
It just means that it's even more expensive. So I feel like we're just chasing our tail going, oh, maybe we're getting close here. And then looking at the realities and going, nah, that's because we want to get to a point where we can see green shoots. We can see apartment buildings coming out of the ground in some of these precincts that John Carey's trying to open up around Perth. And then go, okay, from here, I reckon there's still another 3 years before you see any of that volume come into the market in the first place. But I'm struggling at the moment.
And so when we're talking back to the green shoots concept, certainly there's going to be complexes come out of the ground, and there's some press around that. So Celsius in North Perth, and then probably some stuff through Subiaco potentially, and then obviously the Blackburn Group, and we're talking about a different product here in terms of higher rates per square metre and luxury, but they're in discussions with builders on some of their sites to try and get things up and going. But beyond that, it's not like we are in a zone where suddenly all of the developers can go out there and build medium density apartment complexes across Perth Metro. It's still not feasible.
We think about in the last boom, there were so many apartment developers around, and there were brands, their names, their family names, bigger family names too, that just don't exist anymore.
Yep.
And I don't see any of them coming up anytime soon. And what we have there is Willing doing some great work in the medium to smaller space around Mount Lawley and places like that, self-fulfilling.
Yes.
We have Edge, probably the biggest developer at the moment, along with Finbar, self-fulfilling.
Yep.
Finbar, self-fulfilling with Hanson. The Burswood Point development with Golden Sedeo Group, self-fulfilling.
Yes, absolutely.
And because they can't find any builders that they can trust to not go broke, but also there are no builders that would want to do it because they're worried they'd go broke.
Yeah,
and
absolutely.
So all you have left really is like Paul Blackburn, who seems not self-fulfilling, trying to convince someone to build his City Beach development for him.
Yep.
And everyone else not even in the game.
Yeah.
Along, obviously, Celsius just being able to get it in this North Perth development up with Atlas.
Yeah. Yeah, and they may get something out of the ground through Shenton Park, through there. Again, that's actually a really good litmus test for rates per square metre and values going up and making those projects viable, that was a state government DevWA-led development there in the Montario Quarter, the infill development down there.
Good quality stuff other than that BGC development everyone is worried about cracking.
Yep. And great
concrete.
location, walking distance to a train station, funnily enough, and really good cafe. There's actually a Coles supermarket there that most of the world's forgotten exists. Yeah, I think it's a fantastic location, really good infill idea. Maybe the density could have been higher in retrospect, but that's what we do in Perth.
Let's segue into train stations then and talk about John Carey's precinct plan that he's just thrown a mallet on the table and gone, this is what it's going to be, suck eggs. And I absolutely applaud him for it. You got your classic naysayers who are annoyed they didn't get to have a say, but you've had a say, guys. You've had a say for the better part of the last 6 years. Your say has been, we don't have a problem with quality infill. We just want it to not affect traffic and not affect this and that. We don't infill in the first place. Delay, get on with it, mate. Yep. We are trying to fix the problem. So well done, John Carey. That's my opinion, at least. Yours might be slightly different, Brendo. Given that he wants to put density in your backyard in Cottesloe.
Yeah. Oh, look, I think it's a fantastic plan. I think that everyone that is concerned about it should probably go back to Alana McTiernan's days as Transport Minister. These are called transit-oriented developments. They're a worldwide planning phenomenon design.
Or norm.
Yeah, they're all over the world. And so probably just a little bit of research by people would be fantastic. Now, there's some really quirky stuff going on here. If you draw a line 800 metres from Cottesloe train station west, it takes you most of Seaview Golf Course and gets right down to the eastern side of Marine Parade. So clearly they're not going to try and put apartments on Seaview Golf Course.
Or Broome Street.
Or Broome Street, Marine Parade.
Maybe he wants to, Brendon.
Who knows? Yeah.
And they'd be great views.
They would. What they're trying to do is obviously create precincts around stations because it's logical that you bring density to those particular locations. So if we start with some of the naysaying stuff, number one, local councils have had control of that planning policy over a long period of time and could have influenced how that development works.
And didn't.
Unfortunately, they haven't been able to come to an agreement around that, and that just gets down to having way too many opinions and self-interested parties around the table. That's just the honesty of how that works. People that coming out of the woodwork and wanting to stop it as opposed to being for it. I'll just cover traffic as well. So the concept here is that there's not as much traffic when you bring density because everyone's going to live so close to this train station that it's more logical to jump on a train and go to work or to cafes, entertainment, sport. So you literally walk out of your apartment to the train and then you're close to the venue at the other end. So it makes a lot more sense than getting in your car. That's how other large cities around the world work. Everywhere around the world has much less car ownership than Perth. So you would potentially in these units have one-car households as opposed to 2 or 3 car households that we have at this point in time.
Let's look at quickly the list of train stations that he wants to invigorate or gentrify here. We go in alphabetical order. Ballajura, Bassendean, Carlisle, Claysbrook, Cottesloe, Glendalough, Morley, the new Morley one, Mosman Park, Redcliffe and Swanbourne. Now, Finbar's Ronald Chant made a good point a couple of days ago. He said, no one's building in Balladura. It's not happening. The price points don't work. So the question is actually a good one. Is half of this a bit of a pretend policy to go, it's actually not going to happen anyway? You can see how it would work in Cott. You can see how it would work in Mozzie Park and Swanbourne. You can probably see how it would work in Glazebrook. It may work in Bassendean. It may work in Redcliffe for certain product, build-to-rent stuff that would impact the FIFO industry especially.
Yep.
But I don't see how it would probably work around Oat Street, Balladura, Morley. There's a couple there that I just think you probably could have replaced that with North Fremantle, Vic Park, and even Bayswater. If you look at Bayswater, the city of Bayswater actually has been trying to increase the density there for a while. There are developers who own land waiting for it to work. It's just the density's not dense enough to make it work, right?
Interestingly, out of all of those, there's a couple of things going on that I look at from a development point of view. So we're back to the feasibility discussion. Balladura potentially doesn't work because a purchaser is only going to pay, say, $700,000 for a 1x1, $800,000 or $900,000 for a 2x2, they can pretty much buy a house locally or a villa locally for that price point.
What discount do you reckon you need? Do you reckon you need to be about 20-25% lower than the house or the unit?
Yeah, I think it's probably coming down to maybe as low as 10%, just as we get more desperate. Then if you go to the feasibility in terms of the design, so if you look at an easy comparison, because they're only a couple of k's away from each other, Swanbourne versus Cottesloe. Cottesloe has a large amount of flat land, in particular on the western side, where there's just a big car park. There is a power substation there that creates a massive problem, but it could put pretty much a subterranean car park of one level plus car parking on top of that and more apartments, and you're probably going to get river and ocean views and higher values in terms of luxury product. You go up to Swanbourne, not that much excess land. The railway is actually below the road. You can probably put a lid on that, but in terms of development costs, you're starting to get through the roof in terms of the infrastructure of developing some apartments. They're a great idea, great location for it, and all honesty, it's not very far from my house. Maybe I'll have a complaint about traffic once it's built.
Mate, you'll be taking the train. Your office is right near the train station.
Absolutely.
You'll get out of your house, straight to the train station. You'll be there, and you'll be in quicker than you would be on all that traffic on Railway Parade.
Yeah, depending on which day of the week. I am on the train sometimes at the moment. Then we go to some of those other locations. Glendalough, in terms of building affordable housing, there's large tracts of land around there that, unfortunately, some of it has been underdeveloped from a density point of view.
Like the walk-up
flats. There's more opportunity there into the future as well. So each station will have its different quirks. To come back to North Freo and to Alana's, there was a plan for a lot more density in that location than ended up there. And again, we probably undersupplied it a little bit, but it did hit the GFC in terms of the developments that actually ended up happening there. But if people want to understand what things look like into the future in terms of a transit-oriented development, then North Freo is a good reference point. But again, the unused land between North Freo and Victoria Street train stations is ridiculous. The train line is below the road level of Stirling Highway for a long parcel of land there. It's government-owned land. Back then, there was some development ideas around some subdivision through there. Probably the design wasn't fantastic, but look at this excess land sitting in a prime location on the coast, probably for some mid to low-rise apartment, bit of density, some great views and excellent lifestyle.
It looks a bit rural there, doesn't it? Like there's a good kilometre there where you think, are we in Perth?
Yeah, it's full-on marshalling yard. And if you came into our city from any other city in Australia and said, up the road is a $5 million block of land on the front on Marine Parade, that's what it'll cost you to get in, but this land here is excess and unused, they'd probably laugh at you. It's quite ridiculous in terms of reusing or repurposing some of the land in prime locations.
So if you had to be a betting man, which of these train stations will get the first apartment and when will it be finished?
Yeah, that's an easy answer in that Cottesloe in Station Street has an approved development there, a dual tower on the shopping centre site next door. It literally is across the road from the train station.
What about the next one?
That's probably got the best chance of getting out of the ground. But that's not a fait accompli, right? They've got a good design. There's a hotel component to that. There's some excellent opportunity on the ground floor to actually activate the space and get proper retail. But still, they're not guaranteed of getting it out of the ground because of a feasibility angle. It would take them, if they started tendering the builder side of that contract tomorrow, it's probably going to take them most of the year to get that organised, to even think about starting. So I'm just giving people the perspective that even though there's an approval in place, that Cottesloe development probably can't start for another at least 1 year, probably 18 months. So when you're getting fired up and worried about what's coming to your local area, just remember that any development's probably 2 or 3 years away. From there, I actually think because it's logical and because the infrastructure is in place, what I'd like to see would be the Redcliffe one, because there's a lot of single residential development around that station. The station is prime for an authority. It'd probably have to be government to come in and take control of that area, amalgamate some of the land holdings. All of the infrastructure is down the road in terms of shopping centres. You could walk to Costco. What an amazing feature. But also, you
couldn't walk back, though. The bags would be too heavy.
Yeah, you couldn't, because you'd need the bulk trolley.
Yeah.
And so, yeah, I think that's probably would require some assistance, though, in terms of what you're trying to do there is produce affordable type product into a marketplace that can probably handle it in terms of what the land area is and the infrastructure around it.
Do you reckon that's where we are, though, where to get any apartments up that are not in the Golden Triangle, the government's got to hand out money? That's what the infrastructure fund is, in a way. Probably got to be more than that, doesn't it?
I think that, I think the general public's probably going to have to get their head around the concept that a state government authority like Development WA has a remit to go and make money on the way through, like any developer would, in terms of creating opportunity. Changes from project to project. But if we want to create supply, and just remember from a personal point of view, each person out there will need to come up with some sort of downsizing evolution of where they're going to live into the future. So if you think about where you might want that to be, most likely where you already live, then I think the state government is going to have to be a little bit realistic about their assistance to bring that type of product to locations across Perth. My main motivation there in terms of talking about it is we don't have enough aged care for the boomer generation to go to aged care. They can't all age at home. And those that want to change their lifestyle do need more options than we already have in terms of choosing where they live in the future.
And I think that is one of the sleeping giants of the property industry in general. Is I don't really see us having done a lot of aged care development since stuff was finished from pre-COVID into 2021 sort of time. Your Brightwaters, your Aegis, not a lot of them popping up. And there's a lot of old people living in place at the moment. And so I think at some point in time there will probably have to be some sort of federal scheme that incentivizes or lifts rebates or whatever it is to be able to, in a similar way that they did with childcare and created a big childcare development boom. I think at some point there's just going to have to be a big wave of aged care development because people are getting older and there's nowhere to go.
Yeah, and big tension between government levels there. So state government saying it's a federal government responsibility. State government doesn't want to throw the money at it because they know it's a money pit, asking for the federal money to be brought into the state. Obviously, then you start talking about control. So, there's a decent argument to be had there and obviously an immediate requirement.
Now, I guess this brings to the whole theme of John Carey's continual process of taking powers away from local governments that, for the most part, across the board, are not productive enough. They've created the issue, or they've been a big part of this lack of supply issue in the first place. Just too many, as you said, too many cooks in the kitchen, nearly. If you want to slow down a process, create a committee. So is continuing with this run of bringing a lot of these functions to the state, is it a good thing?
Look, there's a couple of different things that could have happened here. I think, unfortunately, my opinion is that we missed a trick when Colin Barnett tried to merge lots of the councils together. If you go to other cities, even just within Australia, they have a lot less local authorities in their capital city region or their metro region. And Brisbane's the shining light. I think they've got 2 councils across the whole of Brisbane Metro. So if you're yelling at your podcast going, I'm crazy, you can't merge all those councils together, then it's already done and already operates in other parts of just Australia in terms of a system of 3-tier government.
And clearly a more progressive planning system in the Brisbane City Council. If you go there, it's far more democratic the way that people are able to access the river and you don't have these 11, 12, 1,300 square metre lots blocking everyone's access onto it. There are pathways for cycling along it and everything. And it just feels like a place that clearly has got far less people standing in the way of progress. And progress doesn't happen just because we say we want to progress. It's happening because we're having 70, 80,000 people a year come into this state.
Yeah. And so then you come back to those local councils, are they in the strategic zone to understand that we're a progressive city, and are they coordinating together to cater for that? They haven't done that historically. It doesn't matter which council you look at. Some of them are really forward-looking and some backward-looking and would like no development in their location. But unfortunately, what we've ended up with in terms of the way that system's worked is it was open to the people that had a negative view of the future in terms of halting development, taking some sort of ownership control because they were more motivated to do that. That held back lots of development and lots of progress, in particular in the locations that people want to occupy, as in between the city and the coast. We're coastal dwellers in Perth. The Western Suburbs Councils definitively held back that development over a long period of time and unfortunately really missed a trick. When we had building costs that were probably below market, we missed out on, and I'm thinking of City of Nedlands here in terms of the developments around the car yard precincts there on Stirling Highway. We could have had supply into that marketplace. I know the design could have been better and we could have all agreed about it a little bit more, but we've ended up with nothing. And as we've already said, it's not feasible to go and build that now. So
for a long time, and people will be very happy about that.
Some people will be really happy. I would like to ask them whether they're happy with empty car yards sitting on Stirling Highway because they're all empty at the moment. They're for lease. It's only a matter of time until someone starts vandalising them. And is that a good outcome? I'm not sure it is for the future.
Let's talk about the future. We've had Michelle Bullock make it pretty clear that for the time being, we're not going to see any more interest rate cuts. Now, that's obviously a surprise to where the market was pricing in. I think the market probably had 2 more cuts priced in by the end of this year, and it's not happening because the inflation number is a bit higher than we'd like recently, and the unemployment number is a bit lower than we expect it to be. So how does that impact the run we're having at the moment from allowing the demand and supply side to continually fuel price growth?
Yeah, so there's lots going on there, Trent. Number one, long-term interest rates aren't the most influential thing on house prices in Australia. I know that everyone loves to connect the two, but interestingly, there's some data out there at the moment that suggests that post-COVID, most mortgage holders in Australia have taken a very conservative view on their debt. And by that, I mean that they've got very low LVRs on their existing home. And so the equity that they've built up has driven part of this cycle. The interest rate that is out there at the moment, generally, an existing mortgage holder has their budget and their head around in terms of being able to handle that. Unfortunately, from our point of view, in terms of trying to make that interest rate more affordable, in particular for first home buyers, the inflation side of the equation needs to be brought under control from the RBA's point of view. That might not be the same view as lots of other economists, but I think they probably did get a surprise in terms of the pressure on inflation, in particular on the East Coast economy, because I think that cost of living in Sydney and Melbourne in particular is extreme at this point in time. Funnily enough, for the Perth market, it actually probably means that we get a little bit of control on interest rates. We just a little bit of back of the mind for decision makers of going, can I afford my mortgage into the future if interest rates don't continue to go down? So that might take a little bit of an edge off the frenzy, which hasn't always been the case in our marketplace. Often because we're counter-cyclical to the East Coast, interest rates would be going down just as our market's going up. So it's probably not such a bad thing. Interesting to hear that Westpac chief executive is saying that there's 2 interest rates cuts to come next year, whilst Matt Coman, the CEO of CommBank, is saying there's probably only 1. So obviously everyone's still in disagreement about what happens next. And probably the lesson here for people is to do your budget on your mortgage at the current interest rates, or even maybe a quarter of a half a point above, to make sure that you can afford the debt that you're taking on to make your property purchase.
Because no one knows what's going into this future. I think this is a time more than ever where none of us have a real sense of where the economy is going. And I'm thinking more globally here. There's massive risks in the American stock exchange right now with AI bubbles and bubbles bursting on things that we don't know how much they impact us or if they impact us at all, because it really circles around to confidence in the market. Money is falling away from certain markets in Australia. How much are we invested into the American AI bubble? I don't know. I don't think many people really know. But what we do know is our impacts at the end of the day come down to how many people come into this state. And we know that our monthly numbers are actually still right up there near the record numbers again this year, which is why we're continually seeing these price points.
Yes, pressure on housing.
Exactly, and how many houses we can build. And we know that we're leading the country at the moment, which John Carey would say he's very proud about in terms of how many numbers we're building right now. But we also know it's still nowhere near enough for the people that are still coming in. And therefore, the last question really, I guess, just comes down to things like mortgagee in possession. Now, we haven't spoken about mortgagee in possession, which is data on banks taking back people's houses because they can't pay their loan for a few years now. But we used to be the owner of a few suburbs that were leading the country in MIPs, right?
Yep.
Have we had any uptick in that stuff?
No uptick. I actually saw some data from a non-bank lender last week in relation to mortgage arrears. In Western Australia, they were in regional locations where it's not even worth me saying who they are because it's not legitimate data that can be measured to reflect where mortgage defaults are. Yeah. Same in NT, and Adelaide had a couple of suburbs that were traditional lower socioeconomic locations, and the same for Hobart. So the mortgage arrears data is showing very low numbers.
Isn't that surprising? Like when you get to really high numbers in a cycle where people are starting to say, hey, we're at the back end of a cycle rather than the front end.
Yep.
And I'm not suggesting I agree with that. But if you were to be saying you were in that position, you'd see MIP numbers starting to really rise, right?
Yep. Yeah, and so what this is telling us is the majority of people are still able to afford their mortgage, are able to get it structured to a level that is acceptable to their budget and go shopping for an interest rate that they can work on. And then the other real key thing here is that we don't have any negative equity scenarios that we had in the last MIP cycle. So it might be okay for you to go and get your mortgage sorted out from a mortgage stress point of view and your cash flow point of view. But if you're trying to pay the debt off on a house where it's worth less than what your mortgage is, that creates a whole new level of stress in your life that usually doesn't come with a great outcome.
That's mortgage prison.
And so you end up going MIP on that because you're in negative equity. And those scenarios are not in our marketplace at this point in time because the market's grown so significantly in value.
So I think that's a good one to talk about, just trying to identify downside risk. We also know that the rental vacancy rate is a canary in the coal mine. That hasn't really been moving in terms of how many rentals are available. It's about the same this year as it was last year, as it was the year before, in the same way that our sales transactions are exactly the same as every year at the moment.
Yep.
This is our last podcast, Brendo, for this calendar year.
Yep, this is daunting, man.
Yeah, what do we expect to be talking about first quarter of next calendar year after the nice holiday and tan you will have experienced?
Do you get to tan in
I don't
New
know
Zealand?
that you tan,
I'm not
actually.
sure.
Yeah.
No, I just don't. I just turn red and then get skin cancer. But
why am I laughing?
It's all right. I've got a good skin doctor and some sunscreen. But yeah, look, with the interest rate story happening, I think that will bring a slight dampener to our market. I think that we will be sitting here with hopefully more stock on the market into the new year because things will have settled down slightly. But I say that with a lot of trepidation because there's so many people missing out, and we used the example before of 30 offers on a house. So the 29 people that missed out still have demand out there in the marketplace, right? A portion of them may be East Coast investors or local investors. So even if you take out 30%, then you're still left with 10 to 15 people are looking for a house and they don't go away within the next 2 months. So supply will still be significant in terms of the pressure there with the demand coming. We won't have structurally solved any of our problems because you can't instantly bring supply to our marketplace. And then I think it'll be about people finding their individual opportunities around the marketplace. So looking out for that price point where you might be able to get into a different product. A little bit of downsides or activity might help a little bit, but there's nothing going to structurally change our market through December and into January other than a little bit of pressure being taken off the demand side of things. Yeah.
Is it just more of the same next year then?
Look, it's hard to see, again, put aside the concept of global economic shock. The only other thing that I could see influencing our market down would be a dramatic change in immigration policy. And again, look, that might be really political out there and everyone might want to debate it a lot, but bottom line for the federal government is that's significantly driving our market in terms of the economy in Australia, and it will be a very difficult decision for them to reduce.
I just don't see it happening in this political cycle. I can see it becoming a big issue in the next election campaign. We're 2027.
Yep.
We're talking that starting in 2027 into 2028 election.
Yep.
I think One Nation is going to be continually increasing their support, taking that away from conservative Liberal voters and just becoming angrier and angrier, and that may have an impact on the way Labor reacts to that.
Yep.
Labor probably gets in again, but maybe a little bit more conservative about the way they let people in the next cycle. But what we're talking about here is 26, no change.
Yep.
And 27, no change.
Yeah.
And maybe that starts to impact how things go after the next election in 28.
Yep. And then the other cohort that will more than likely be attracted to WA is the New Zealand economy is not going as well as it could be. In fact, there's some significant redundancies over there, pressure on interest rates and pressure on wages.
I love Perth.
And they love just jumping on a plane and coming all the way over here. And I think that they will be seeing the opportunity in WA. The last time that we had a mining construction boom here, there was 50-odd thousand Kiwi construction workers in our marketplace hanging around. They're the ones that went home at the end. So there's the ones that stayed as well. So really what I'm alluding to is that migration story into Perth could come from New Zealand into the near future as well.
Okay. Have a great Christmas, mate. Thank you very much. We'll
Absolutely,
probably
mate.
have a chat about the regional market before then.
Yes.
But with regards to the Perth metro market, thank you so much for your time and your insights this calendar year. What a year of mental numbers it has been. Neither of us, I think, expected to see some of this happen.
No, absolutely.
Especially the Stockholm market.
2025's been a wild ride, mate.
Cheers.
Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!